Hello, everyone. The world has seen a whirlwind of significant events recently, and today we're diving deep into some major economic and geopolitical shifts. We'll explore how China's strategic moves are impacting global giants like Intel and Boeing, shaking up the tech industry, and potentially reshaping the entire global economic landscape. Stay with us as we break down these complex developments. Before we get started, if you find our analysis insightful, please consider subscribing to our channel and hitting that like button. Your support is crucial for us to continue bringing you in-depth reports like this. Also, let us know in the comments where you're tuning in from. We love hearing from our global audience. We'll have key takeaways and conclusions at the end of the video, so make sure you stick around. What exactly did China orchestrate to make Intel shed $100 billion in a mere 48 hours? On April 12, 2025, a significant event unfolded. China caused Intel to lose a staggering $100 billion in market value within just 2 days. This wasn't a random market fluctuation. Intel's stock value subsequently plummeted by 18.3%, a downturn that markedly impacted 27% of the company's total earnings. The critical question arises: how will this strategic maneuver alter the trajectory of the global technology sector? China dealt a substantial blow to Intel, signaling a potential shift in market dynamics. On that pivotal date, April 12, 2025, the Chinese government prohibited its agencies and major corporations from acquiring semiconductor chips produced by U.S. manufacturers, a list that prominently includes Intel, AMD, and Micron. This directive was far from an arbitrary incident. It represented a meticulously calculated strategic action. The immediate consequence was severe. Intel hemorrhaged $100 billion in valuation in just 48 hours. So, what unfolded next? Intel's stock price plunged by 18.3%, effectively erasing $100 billion from its market capitalization. This vulnerability stems significantly from Intel's reliance on the Chinese market. China constitutes 27% of Intel's revenue, translating to approximately $22 billion in the year 2024 alone. This heavy dependence rendered Intel an accessible target for a potent economic assault orchestrated by China. Please make sure to watch this video until the very end, as we will be drawing important conclusions from these events. The repercussions extend far beyond Intel, impacting the entire United States technology industry. Intel was not the sole entity affected by this calculated move. The sharp decline in Intel's stock value triggered a domino effect, dragging down major semiconductor indices such as the SOXX and SMH, which experienced drops of 4.2% and 2% respectively. This incident starkly highlights Intel's over-reliance on the Chinese market. When this vulnerability was exploited, the entire U.S. tech ecosystem felt the tremors, facing significant operational and financial difficulties. These consequences are not confined solely to Intel. They ripple outwards, affecting numerous other technology firms and fueling concerns regarding the stability and resilience of the global supply chain infrastructure. If the U.S. semiconductor sector fails to diversify its markets and supply sources rapidly, it risks confronting a protracted period of crisis, potentially altering the balance of power in the global tech arena. China's long-term objective is clearly aimed at fundamentally reshaping the technological landscape. Beijing hasn't merely severed connections with Intel. The nation has established an ambitious goal to systematically eliminate U.S. manufactured chips from its public infrastructure and energy systems by the year 2027. Industry experts forecast that this strategy could potentially erase up to $350 billion in annual revenue from American chip companies by that deadline. Achieving complete technological self-sufficiency presents a formidable challenge, demanding immense investment and innovation. However, China's strategy is advancing rapidly, propelled by substantial governmental efforts to cultivate and expand its domestic chip manufacturing capabilities. The global technology industry could soon undergo a significant transformation. Should China succeed in its ambitions for technological independence, it won't just be the United States feeling the impact. Other nations currently reliant on U.S. semiconductor technology will inevitably face substantial alterations in their supply chains and will need to reassess their strategies for global technological self-reliance. This shift could lead to a more fragmented global tech market, with regional blocs potentially emerging around different technological standards and supply networks, fundamentally changing international collaboration and competition in this critical sector. Huawei stands as perhaps the most significant challenger to U.S. technological dominance. Demonstrating remarkable progress, Huawei has successfully manufactured 5-nanometer chips, utilizing deep ultraviolet (DUV) lithography, achieving this feat without relying on the more advanced extreme ultraviolet (EUV) technology, a capability the United States once considered unattainable without its assistance or technology access. This breakthrough serves as compelling evidence that China possesses the capacity to independently produce cutting-edge semiconductor chips, significantly reducing its dependence on American technological support. How might this development reshape the competitive landscape? If Huawei can replicate this success achieved with smartphone chips across other demanding sectors such as servers, cloud computing infrastructure, and artificial intelligence hardware, it represents a fundamental shift. This is the pivotal question currently occupying the minds of technology experts globally. With the demonstrated ability to independently manufacture advanced chips, Huawei is not only engaging in direct competition with established giants like Intel, but is also exerting considerable influence over the pricing and availability of high-technology products on a worldwide scale. Should Huawei maintain its strong developmental trajectory in this domain, consumers globally might witness a substantial rebalancing in the tech market. Chinese-produced technology could become increasingly prevalent and competitively priced, thereby posing a direct and formidable threat to the long-held market dominance of U.S. technology corporations. The impact of these shifts is already being felt by American consumers. Major computer manufacturers like HP and Dell have announced price increases ranging from 12% to 17% for machines incorporating Intel chips, directly passing on the increased costs. These supply chain disruptions and tariff impacts are poised to escalate the prices of a wide array of electronic goods, creating a direct financial burden for consumers. It's not just computers. Essential devices such as phones, servers, and other high-tech products are likely to experience similar price surges. This trend contributes significantly to the rising cost of living, making everyday necessities and technological advancements more expensive for American citizens, particularly affecting households with limited disposable income. The reality American consumers face is one of mounting price hikes and potential product shortages in the near future. China has also decisively cut strategic ties with ASML and TSMC, further intensifying the situation. Is the Western chip industry facing an imminent collapse? China stunned the global community by ceasing cooperation with ASML, the Dutch lithography giant, and TSMC, the Taiwanese semiconductor manufacturing powerhouse. This wasn't merely a pause. Between 2022 and 2024, China strategically invested $75 billion into its domestic semiconductor sector, concurrently attracting over 50,000 engineers and imposing a hefty 84% tariff on specific U.S. goods. This sequence of actions raises a profound question. Does this mark the conclusion of Western supremacy in the crucial chip industry? The severing of these strategic connections underscores China's determined approach. Beijing didn't simply halt purchases of advanced equipment from ASML and TSMC. It made the calculated decision to terminate all forms of cooperation entirely. This move serves as a potent reaction to the mounting pressure and restrictions imposed by the United States and its Western allies. For instance, in 2025, the Netherlands, reportedly at the behest of the U.S., blocked the supply of critical DUV lithography machines to China within a 72-hour window. China's response was swift and decisive, a complete severance of ties with both ASML and TSMC. This action transcends being a temporary measure. It forms a core component of China's long-range strategy aimed at seizing control over the future trajectory of its own semiconductor industry, insulating it from external pressures and dependencies. China's response to sanctions has been multifaceted and assertive. From the initial imposition of sanctions by the U.S. and Western nations, China refused to decelerate its technological ambitions. Paradoxically, These very sanctions appear to have catalyzed and accelerated the advancement of China's indigenous semiconductor industry. Between 2022 and 2024, the nation channeled over $75 billion into research and development. This massive investment aimed not just at achieving self-sufficiency in chip supply, but at forging a completely independent semiconductor ecosystem. Reinforcing this drive, more than 50,000 engineers, many sourced from leading tech firms like Huawei, have bolstered China's chip research and development workforce. Crucially, China is not merely weathering the sanctions defensively, it is actively retaliating with significant force. The imposition of an 84% tariff on U.S. exports in 2025 stands as a direct counteraction to prior American tariffs. This escalating tit-for-tat has sent shockwaves across the global economy, amplifying concerns about the growing friction in international economic relations. China's technological breakthroughs further illustrate its strategic resilience. The country hasn't limited its response to sanctions to mere retaliation. It has proactively pioneered alternative technologies to circumvent reliance on Western tech. A stellar illustration is Huawei's introduction of the Mate 60 Pro smartphone. This device incorporates a 7-nanometer chip, remarkably produced using DUV lithography, bypassing the need for ASML's restricted EUV technology. This achievement underscores China's rapidly growing capability, not only to match existing technologies, but potentially to develop superior proprietary solutions within the chip industry. This represents a significant leap, signaling that China's pursuit of technological autonomy has reached a critical threshold. Furthermore, China is actively investing in developing its own lithography technologies intended to eventually supplant EUV systems entirely. This would empower Chinese manufacturers to produce ultra-small, high-performance chips with confidence, completely independent of expensive and politically sensitive Western technologies. Within just a few years, China has demonstrated an ability to overcome technological hurdles previously deemed insurmountable, challenging the established global order in semiconductor manufacturing. The long-term strategy underpinning these actions is clear. China's ambition extends beyond simply manufacturing its own chips. It involves constructing an entirely self-reliant technology ecosystem, insulated from Western influence and control. Cutting off relationships with pivotal players like ASML and TSMC is an integral part of this overarching strategy to achieve global dominance in the semiconductor sector and drastically minimize dependence on major Western corporations. This strategic shift is not only reshaping China's industrial landscape, but is also fundamentally disrupting the entire global technology industry. Western firms, particularly those heavily invested in the Chinese market like ASML, are confronting severe consequences as their revenue streams from China diminish sharply. However, the ramifications extend beyond the semiconductor field. China is concurrently executing a wider financial strategy, positioning itself to exert greater influence over global financial markets. It is evident that these changes are not merely tremors within the tech sector, but are generating substantial turbulence across international financial systems as well. China has not merely shielded itself from sanctions, it is actively forging a new wave, establishing itself as a formidable competitive force within the global tech industry. The critical question remains: can Western nations effectively adapt to and withstand this fundamental change? The situation has escalated with a sudden ambush. China has ordered a freeze on all investments flowing into the United States. This quiet decision carries devastating potential power, threatening to push the U.S. economy towards an unprecedented financial crisis. The decline in Chinese investment in the U.S. over recent years has already been alarming. Dropping from a peak of $46 billion in 2016, it dwindled to a mere $2.3 billion in 2024. Now, with China implementing a complete freeze on these investments, the inflow is effectively reduced to nearly zero. A significant question looms. Why has China opted to entirely halt this capital flow? The answer isn't straightforward. China isn't merely ceasing its investments, it's enacting a long-term strategic plan. This involves redirecting capital away from the U.S. towards regions deemed more politically and economically advantageous to China's interests. This isn't a spontaneous reaction. It's a deliberate, strategic, and calculated maneuver with far-reaching implications. Simultaneously, U.S. businesses find themselves grappling with a potential financial nightmare. The abruptness of China's investment freeze has caught many off guard. In just one night following similar past shocks, companies like Hartwell Tech experienced losses amounting to $180 million. To remain solvent, businesses have been forced to secure emergency loans, often at exorbitant interest rates reaching as high as 11.3%, nearly double the standard rate. This predicament not only places companies in a precarious financial state, but also risks pushing them toward bankruptcy should these challenging conditions persist. Furthermore, these high interest rates are not solely a burden for large corporations. They translate directly into increased costs for American consumers. The loans taken out by businesses to navigate this crisis will inevitably lead to higher prices for the goods and services consumers rely on daily. Ultimately, the freeze on investment is not just impacting corporations. It poses a direct threat to consumers through escalating costs. Coupled with the hefty tariffs imposed on goods imported from China, consumer prices are already skyrocketing. Projections indicate that, on average, each U.S. household may need to allocate an additional $1,950 annually, simply to cover basic consumption needs. Concurrently, corporate profits, as reflected in the S&P 500 index, are declining, while inflation persists at a concerning 3.6%. This convergence of factors signifies a probable decline in the quality of life for many Americans, as wages remain largely stagnant, while the cost of essentials continues its upward trajectory. Major projects, previously viewed as indicators of U.S. economic recovery, are now being halted or indefinitely postponed. For example, Intel's ambitious chip factory plans and initiatives related to advanced battery and robotics development in Ohio have been suspended, primarily due to the sudden withdrawal of anticipated Chinese funding. Moreover, a significant 62% of U.S. manufacturers now report facing severe financial constraints that impede their plans for production expansion. This crisis isn't limited to large enterprises. It's threatening millions of jobs across the nation as domestic manufacturing projects stall or are canceled, inflicting considerable damage on the overall economy. The economic fallout doesn't end there. Capital flight from the U.S. market is accelerating at an alarming rate. In a span of just 90 days, an estimated $120 billion has been withdrawn from U.S. stock exchange-traded funds, ETFs. This isn't merely a transient dip. It strongly indicates a significant capital exodus. Investors are increasingly wary about the stability and future prospects of the U.S. economy, particularly as other global markets present potentially more attractive opportunities. Even countries that were previously major investment partners like Norway and Japan are now scaling back their investments in the U.S. market. This trend not only exacerbates the capital shortage within the U.S. economy, but also substantially diminishes the nation's financial leverage and influence on the global stage, challenging its ability to maintain its position as the world's leading economy. Compounding these issues, the U.S. is confronting a looming debt wall, with businesses needing to refinance $4.1 trillion in debt maturing by 2026. In this environment of shrinking foreign capital, U.S. companies are increasingly resorting to high-yield junk bonds to secure funding, with yields reaching as high as 9.6%, double the rate observed in 2022. This paints a clear picture of an impending debt crisis, foreshadowing higher borrowing costs and significant operational hurdles for U.S. businesses moving forward. The cancellation of Boeing orders by China serves as a stark case study of these interconnected pressures. Is this the decisive blow that could paralyze the American aviation industry? A staggering 9% of Boeing's stock value evaporated almost overnight. An estimated $12 billion in annual revenue is now jeopardized. Furthermore, over 1,200 Boeing aircraft, previously destined for China, are now grounded, awaiting new buyers. China's complete halt of all Boeing deliveries is a major development. But is this purely retaliatory, or does it signify a fundamental turning point for the entire global aviation sector? The decision by China to halt Boeing orders represents a move that has sent shockwaves through the industry. By the close of 2024, Boeing's global order backlog stood at 4,500 aircraft. Critically, Over 1,200 of these were earmarked for China, accounting for 26 to 28% of the total orders. Given that each aircraft carries a price tag between $110 and $300 million, China's business represented approximately $10 to $12 billion in annual revenue for Boeing. However, the Civil Aviation Administration of China issued an abrupt directive: suspend all deliveries of Boeing aircraft. There were no prior negotiations, no advance warning, just a single decision that immediately roiled markets. The consequences for Boeing were immediate and severe, with its stock plunging and dragging down related economic sectors. Within days of China's announcement, Boeing shares tumbled by 9 to 10%. This wasn't just a fluctuation in numbers. It was a potent market signal indicating deep concerns about the company's future. Projections suggest Boeing could forfeit up to $40 billion in market value over the next 6 to 12 months if the situation remains unresolved. Should this trend persist, the losses could escalate to a staggering $150 billion over the coming decade. Why does this single decision wield such far-reaching influence? Because the aviation sector is a cornerstone of American exports, playing a vital role in mitigating the U.S. current account deficit. The annual value of U.S. aviation exports typically hovers between $130 and $140 billion, with China representing a significant 15 to 18% share of that market. Losing access to this crucial market could cost the United States billions of dollars annually for the foreseeable future. The breakdown in the supply chain triggered by China's actions puts thousands of American jobs at risk. The impact extends far beyond Boeing itself. Over 30,000 individuals are directly employed in Boeing's commercial aircraft division. Additionally, thousands of supporting companies spread across all 50 U.S. states are intricately linked to Boeing's production cycle. This complex web involves over 11,000 suppliers, providing everything from engine components and electronics to passenger seats. These suppliers, located everywhere from Utah, titanium, and Oregon, avionics, to Texas, seat manufacturers, are profoundly reliant on orders connected to China. Every component represents not just a part, but local jobs, families, and livelihoods. If these Chinese orders permanently vanish, these suppliers could be compelled to eliminate between 5,000 and 10,000 jobs in 2025 alone. This figure could escalate substantially if the situation drags into 2026 and beyond, creating significant economic hardship in communities across the country. Consumers are inevitably feeling the direct impact of this geopolitical maneuvering. The shortage of aircraft isn't merely a concern for corporations. It translates into tangible consequences for travelers. Ticket prices are likely to surge as airline capacity tightens. International routes, particularly those connecting the United States and Asia, may face cancellations or significant delays due to the unavailability of replacement aircraft. Popular Boeing models like the 737 MAX, 777, and 787 are extensively used by Chinese airlines. Transitioning to alternative aircraft, such as those produced by Airbus, is a complex and costly endeavor, requiring months of pilot and crew retraining, substantial infrastructure modifications, and incurring millions in additional expenses. Is Boeing ultimately paying the price for a protracted geopolitical conflict? The company had anticipated generating $9 to $10 billion in revenue from China in 2025. Now, that projection is rapidly approaching zero. Industry analysts express grave concerns. If China fully commits to sourcing aircraft from Airbus and its own domestic manufacturer, COMAC, Boeing risks being permanently excluded from the world's second-largest aviation market. Some insiders fear that without immediate and effective adjustments, Boeing could lose access to the lucrative Chinese market for the next 3 decades. This situation transcends a simple business disagreement. It serves as a powerful case study illustrating how geopolitical tensions can drastically reshape global markets, redefine international partnerships, and fundamentally restructure intricate global supply chains. With contracts worth over $150 billion hanging in the balance, $12 billion in annual revenue disappearing, and thousands of jobs on the line, the American aviation industry is now confronting a critical test of its resilience and long-term viability. China's counteroffensive is multi-pronged, involving tariffs, strategic shifts away from the US dollar, and leveraging its dominance in critical resources, signaling a major global power shift. China's imposition of a 125% tariff on US exports sent immediate shockwaves through the markets. But this is likely only the initial phase of a broader strategy. The move away from the US dollar is accelerating. What does this de-dollarization trend signify for the global economy? The steep tariff, covering critical sectors like automobiles, machinery, and semiconductors, was a direct blow to the American economy. The impact was instantaneous, exemplified by Tesla's market value dropping by over $2 billion within 48 hours, severely hindering its expansion, particularly in the vital Asian market. Giants like Ford and General Motors also felt the strain, facing production cost surges due to pricier imported components and supply chain disruptions, leading to delivery delays. This isn't merely a trade dispute, it's a calculated economic punch. Furthermore, China is actively diminishing its reliance on U.S. financial instruments by reducing its holdings of U.S. Treasury bonds to around $759 billion, the lowest point in years. This move, coupled with the promotion of the yuan and euro in international trade, especially through state-owned banks like China Construction Bank and ICBC halting USD loans, signals a clear intent to build a multipolar financial system less dependent on the U.S. Countries like Brazil, France, and Saudi Arabia are also exploring non-dollar payment systems, potentially increasing transaction costs globally and introducing instability that affects both large corporations and everyday American consumers. This strategic financial shift isn't a sudden reaction, but the result of numerous incremental steps taken over time. American consumers are already bearing the brunt, with new car prices exceeding $50,000 and used car prices hitting $32,000. Tariffs and import costs are inflating prices for various goods, while delivery delays persist. Basic services like oil changes have doubled in price, largely due to increased parts costs. This combination erodes purchasing power and increases the cost of living. The future of the US dollar's global dominance and the structure of international trade is now in question. If China maintains its current trajectory, global EV production could decrease by 6.2 million vehicles, significantly impacting greenhouse gas reduction efforts and challenging the auto industry's production targets and cost structures. U.S. companies face heightened competition, especially in sectors like agriculture, where nations like Brazil and Australia are ready to fill the void left by China's reduced imports from the U.S. These geopolitical maneuvers will ripple through the global economy, affecting nations dependent on exports to China. The U.S. economy itself is showing signs of distress, facing a potential recession. Goldman Sachs estimates a 45% likelihood, driven by declining exports and market volatility. The S&P 500 and Dow Jones have seen significant drops. With stagnant wages and rising inflation, currently at 3.6%, Americans face a declining quality of life. Major economic recovery projects are stalled due to funding cuts, and widespread financial shortages are reported by manufacturers, leading to significant job losses. The auto industry alone lost 200,000 jobs in just 3 weeks. Capital flight is intensifying, with $120 billion withdrawn from U.S. stock ETFs recently, signaling investor concern about U.S. economic stability. As former investment partners reduce their U.S. holdings, the nation faces a capital shortage, weakening its financial power. Compounding this is a $4.1 trillion corporate debt wall maturing by 2026, forcing companies towards high-yield junk bonds, currently at 9.6% yield, and heightening the risk of a major debt crisis. This complex interplay of tariffs, de-dollarization, and strategic resource control demonstrates China's calculated effort to reshape the global economic order.